Hello, and welcome to Financial Accounting. Our topic today is inventory turnover. We will look at how it is calculated and used in decision making. We will also look at the inventory turnover of target corporation and how it is compared to its competitors. It is important to remember that the real value of accounting information is how it supports decision-making. Significant professional judgment and attention to detail are essential. But what ultimately matters is how users of financial information, such as investors, creditors, management, and others, can make well-informed decisions based on fair and accurate information provided by accounting. The accounting processes and information systems that underlie a company's financial statements provide a lot of that information. We looked at inventory in previous videos and already learned that inventory can be the largest of a company's current assets. The next questions to ask are how liquid inventory is and how quickly it can be converted into cash. To answer these questions, creditors compute the inventory turnover. The inventory turnover equals the cost of goods sold divided by the average amount of inventory. The average amount of inventory is beginning inventory plus ending inventory divided by 2. The inventory turnover ratio indicates how many times during the year the company can sell the amount of its average inventory. Note that the higher this rate, the more quickly the company sells its inventory and the more money it makes. The average number of days to sell inventory ratio measures how many days on average it takes to sell inventory. It is calculated as the number of days in the year divided by inventory turnover. By the way, you can find more videos about inventory in the playlist for chapters 6 and 8. Now let's look at an example. For our example, we are going to use Target Corporation. Target is a publicly traded company whose financial statements are posted on the company's website. You can find all the necessary information on Target's website. Look for the investor page, then SEC filing. You need the most recent annual form called 10K. Select annual filing and the year, then open the form. Once you open it, search for financial statements. The cost of goods, also called the cost of sales, can be found on the income statement or statement of operations. The inventory numbers are on the balance sheet. The beginning inventory for the current year is the same as the ending inventory for the previous year. The fiscal year 2021 income statement of Target Corporation shows a cost of goods sold of $74,963 million. The balance sheet shows $13,902 million in inventory as of the end of the fiscal year 2021 and $10,653 million as of the end of fiscal year 2020. If you are curious why the fiscal year 2021 ends on January 29, 2022, look at the notes to financial statements called fiscal year. As stated in the notes to financial statements, Target's fiscal year ends on the Saturday nearest January 31st. Unless otherwise stated, references to years in the 10K report relate to fiscal years rather than to calendar years. Fiscal 2021, 2020, and 2019 ended January 29, 2022, January 30, 2021, and February 1st, 2020, respectively, and consisted of 52 weeks. Note that the ending inventory for the fiscal year 2020 is the beginning inventory for the fiscal year 2021. These are the numbers we will use in our inventory turnover calculation. An average inventory is $12,278 million. An average inventory is calculated as a beginning inventory of $10,653 million plus an ending inventory of $13,902 million divided by 2. The inventory turnover rate for Target, therefore, is 6.11. It is calculated as follows: $74,963 million divided by $12,278 million. We may compute the number of days required for the company to turn over or sell its inventory by dividing 365 days by the turnover rate of 6.11. In the fiscal year 2021, Target required 59.78 days to turn over or sell the amount of its average inventory. I also looked at a couple of prior years and put together a table to see how the numbers changed over the years. Before we look at the historical numbers, let's review where the amounts used in the inventory turnover calculation come from. The cost of goods sold can be found on the income statement, and inventory balances can be found on the balance sheet. Inventory turnover is helpful for users of financial statements as it helps evaluate the liquidity of the company's inventory. Managers and independent auditors may use inventory turnover to help identify inventory that is not selling well and may have become obsolete. A decline in turnover indicates that merchandise is not selling as quickly as in the past. Looking at prior fiscal years, we can see that Target improved its inventory turnover from 6.05 in the fiscal year 2017 to 6.11 in the current fiscal year. It took 59.78 days to sell average inventory in 2021 compared to 60.35 days in 2017. While the difference might look small, it is significant since Target sells billions of dollars of merchandise. Comparing a company's inventory turnover with competitors is particularly helpful in evaluating how effectively a company is managing its inventory, which is often one of its most significant assets. There are a lot of websites that publish financial information on publicly traded corporations. Finbox.com is one of them. Let's look at the inventory turnover of Target's competitors. We can see that the most efficient company on the list is Costco with approximately 12.1 inventory turnover ratio, and the least efficient is Dillard's with approximately 2.9 inventory turnover ratio. Target Corporation is somewhat in the middle. A low turnover ratio can be a leading indicator of poor sales or excess inventory, while a high ratio may indicate strong sales. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you're notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.